Now let's switch to the capital mobility case. This is the case when, well, people, companies in foreign country will make direct investments in a different country. This factor by itself is actually, when it is financial investments, there are some reservations to that, because financial capital is too getting in and out too fast. It creates instability in a country. The interest rates or exchange rate might go too fast up and down, and which may create uncertainty for both investors inside of the country and outside of the country. I mean the direct investors. I mean the ones who want to build actual factories, actual production facilities, which includes also hotels, for example, or service production facilities also included. But direct investments are basically considered as a beneficial investments for the country, and to be better for especially developing countries, it is assumed usually the developing countries have lower capital amount, and actually the investments there are more productive, because as you increase the amount of capital, the productivity of capital is expected to fall. Although there are some objections to that, according to the other idea, poor countries have disadvantage because their all sectors are underdeveloped. So the price of all inputs like labor or electricity or other, for example, raw materials will be high there, because production is not efficient in those countries. So this might deter investors from those countries. But direct investments, as I said, in general, whenever they come, they are considered as a beneficial investments. However, well, the one objection is the capital might bid for better conditions for itself, and these better conditions might involve lower taxes, better working conditions, and better environmental conditions. As a result, I mean the infrastructure that supports those investments got in future unsustainable, and in that case, of course, I mean initially the foreign direct investments might create a benefit for the nation, but in the end, I mean the infrastructure and labor force will degrade in the country. Worse labor conditions might mean the labor force might get less healthy and might get less wage, might be not able to finance education of its children, and worse environmental conditions, of course, also decrease quality of life and make all conditions worse, inputs and labor force quality. As a result, the country might in the end get worse off, and this competition to offer best conditions to the foreign investors might in some cases end up with a case which is called race to bottom. I mean, you all try to get better and better conditions, in that the final conditions that are offered will end up with destruction of the infrastructure in the country. So this is the case of capital mobility. Labor mobility, as I said, is something that is not studied that much, and basically, even though it has become more common, it is not studied that much in the economics, unfortunately. So our starting point will be, to the main topic, will be through balance of payments. Balance of payments is basically, I mean, it is kind of an accounting topic, where you have different costs and revenues coming in and out of the country, and we are taking a country as a whole. We are not looking to the state. In the end, all the money coming in and out should cancel each other. Well, in this case, of course, we are also taking into account if you are indebted, then you need to, for example, if my revenues are $10,000, but my costs are $5,000, then I got a financial extra, let's say. Kind of, it is assumed I make a financial investment, especially if we are talking on a foreign country. The foreign country need to borrow from my country. If they are indebted, they buy from me stuff that costs to them $10,000, but I buy from them stuff that costs $5,000. In that case, they need to borrow $5,000, the rest from my country, and make the payment that way. In that case, that financial the borrowed money that is going to the country is also counted. It is also within the accounting, basically. For me, I have a surplus, but kind of, because I give the debt to that country. Also, I mean, part of my accounting calculations also considers the debt I have given to the other country, which means, again, for both countries, in the end, the total accounting calculation, let's say, calculation will end up with 0. So the different parts will get each other out. Let's see it in more detail. Actually, it will be more clear. So, first type, we have income, money that is flow into the country, and money that is flow out of the country. And money inflow and outflow can be done through different things, from the workers that are working outside or inside of your country, capital that is invested inside or outside of your country, trade, and there can be financial movements. But financial movements are separated from the other type of movements. So we have two different accounts. One of them is called financial account, the other one is called current account. And usually current account is the focus. Financial account is just a mirror of the current account. You will see it in a minute. Basically, it shows the flows resulted in sale of national assets. For example, if I sell my government bonds, in a way, I mean, if I sell government bonds, that means I am borrowed, and each year I need to pay some interest to the person who has the government bonds. Or private company stocks. I mean, it should not be necessarily government. Well, in that case, we have income flow, basically. This as a result of foreigners buying the financial assets of my country. So if I sell my private stocks, I got some money, and that money will make my financial account positive. On the other hand, if I buy if, for example, Bulgaria buys the government bonds of Romania and pays money to them, their financial accounts will be negative. Financial accounts is basically, I mean, by these purchases you make in the financial market, whether money is coming into your country or whether it is going out of your country. That determines the financial account. And that the fact that it is positive might not be necessarily a good thing for you. It might be a bad thing for you if, I mean, you are borrowing money, and if you won't be able to pay that debt easily back, basically. So in a way, positive financial account means the country is accumulating debt, basically. And some of them are, some of the debt might belong to the, well, some of those, the assets you sell might be basically debt instruments, which might mean you financially pay back to the people. But there are also some, stocks are, even though they are considered as financial transactions when a company buys stock, it gives to the companies ownership of the factories or mines, basically. In that case, you got ownership of an actual production facility in the country, and you might be able to get profit share in that case from that facility. So for the current account, three basic things are the sales and purchase of goods and services. That's trade. The money you pay and you get from what you sell and what you buy. Factor income, all different types of income, the interest revenue. Interest revenue is included in the current account. If I got interest from another country, of course, if I pay interest to another country, that this means negative revenue. Basically, it decreases my current account. Rent I got or I pay, or profit I got or I pay, basically. And only labor income is not included in factor income. Labor is included in transfer. So that's basically the workers, foreign workers in, for example, Bulgaria, pay to the people to send money to their countries, basically, either to their families for another reason. Maybe they want their money to stay in the banks, in the financial system of their country. I have actually explained all of this, and I also explained actually this. The sum of the financial account and current account is always 0. So when current account is positive, financial account is negative, which means, in general, when you think whole world is, if you think two countries, of course, two countries models might seem unrealistic, but think about whole world. If my financial account for the whole world is positive, what happens? In that case, the whole world should find a way to borrow money from me and or get money existing in my country to their country to pay the difference. If in total everything I pay to them is 500, everything they pay to me is 400, then they should find this excess 100 in one way or the other, by selling assets or by selling their factories, basically. I should note one thing here. Basically, one thing they can sell as an asset is the currency of the country. So, but that's actually not done, because the currency of one country is already sold to the whole world as an asset, and which gave to that country enormous advantage. So when I buy something from the United States, United States can make payment to me in dollars, and I might not, let's say again the case 500 and 400 case, United States need to pay me 500, I need to pay them 400. So United States might print 100 extra dollar and pay me the money in forms of this 100 extra dollar. And I put 100 extra dollar in my pocket, but that 100 extra dollar in my pocket gives me additional purchasing power in that country, in the United States. Of course, when I deal with other countries, the other countries might also pay me the difference in dollars. So they might have already some dollar stock, extra dollar stock, which again they can use in the United States, but they can pay part of this particular asset called money, national currency of United States, to me. So in a way, whole world is trades one particular national currency, dollar, with each other, and in that currency is asset of United States, but whole world is trading this asset. Kind of euro is also that type of an asset which is traded by the whole world, basically. So we are coming very close to 15 minutes mark, so let's stop here.